Welcome to Financially Speaking. I'm Sean Latter. Now, as the old saying goes, the only certainty in life is death and taxes. Although most of us hope to live a long and healthy life, it's important that we make sufficient financial provisions should we die unexpectedly. In this edition of the show, we take a closer look at life insurance. What is life insurance, and how can you get the most from your life cover policy? Joining me in the studio tonight to give some insights into the ins and outs of life insurance is Raylan Dunbar, Financial Advisor at FinLogic, Leland Porthen, Head of Product Management Risk Products at Liberty, and Dr. Marita van der Walt, Chief Medical Officer at Discovery. But before we jump into our discussion, let's take a look at one of our viewer questions from last week. It's from Sharon in Santon, and she asks the question, I'm divorced. How do I stop my ex-husband from changing me as the beneficiary on his policy? Firstly, good evening. Raylan, would you like to pick up on that question?
Yes, thank you, Sean. Divorce always becomes an interesting situation. What has to happen in most situations is that a wife or ex-wife would rather need to be in a position where they see the policy as an absolute cession to themselves. Now that means that the husband, for example, will have the life cover policy on his own name, but the wife or the ex-wife actually owns the policy through an absolute cession. In this way, the cessionary never is in a situation where the life assured, for example, can go and change the plan details or anything like that, or change beneficiaries or anything. So what happens here is that the ex-wife would have full, and Sharon in this situation would have full, complete control over that policy and make sure that she always remains the beneficiary on the policy.
Okay, thank you. Of course, that assumes the session has actually taken place.
Yes.
If it hasn't taken place, what you're saying is that she then has no rights over it.
Absolutely. A beneficiary, unfortunately, has absolutely no rights on a policy whatsoever. You are just nominated as a beneficiary, and in the event of a death, obviously that amount will pay out to the beneficiary nominated on the policy documents, or in other words, it will also be referred to the estate or in terms of the will, depending on how it's actually been set up.
Okay. Neil, from your point of view, when we start having a look at the sessions and the different parties to the contract, generically, what are those parties to the contract?
I think we've got to be clear, and there's got to be a clear positioning from a sales perspective around the parties to a contract. As Raylan mentioned, you've got an owner, you've got a life assured, and you've got a beneficiary. Mm-hmm. Those are traditionally the people who would have ownership or rights, so to speak, over the contract. And I think there've got to be clear distinctions. The owner is the person who is allowed to make those changes, as you referred to.
Yes.
The beneficiary is the person nominated, and of course the life assured, there's got to be an insurable interest between the owner and the life assured. So those would be just very basically the parties to a contract that you would need to consider.
You picked on something there which was insurable interest.
Correct.
Okay, now that's something that we've heard a lot in the industry, but I'm not sure everyone understands it. Marita, would you like to expand on insurable interest from a party to contract point of view for a life insurance policy?
It normally means that the insurable interest is when somebody would suffer a loss if the life insured died. So it can be a dependent, it could be the bank, it could be somebody that will suffer a financial loss if that person were to pass away.
Okay, so it's something that we can't just have as, I can't own a life insurance policy on just anybody. It has to be someone that I'm either related to or financially dependent with.
That's correct, yes.
Okay, very interesting. Let's have a look now. We understand a little bit of the parties to the contract, but often the question is, why do I need a life cover policy? For a lot of people, it's a grudge purchase. Maybe, Raylan, you can expand on maybe the importance of having life insurance.
Life insurance is a very important aspect of any person's insurance policies. The reason being is that it covers for debt, it covers for any kind of dependence. And very often people are left in a situation where they've got young children, something happens to them, and suddenly they're now in a situation where they don't have enough income to provide to their spouse or to their dependents. So life cover becomes very important for people. And the best thing is to speak to a financial advisor and make sure that your actual needs are fully taken care of.
Okay, so from an importance point of view, we understand that debt and covering your dependents from a lifestyle point of view are important. Now, that's how much I might want, perhaps need. From an underwriting perspective, Marita, what are the limitations placed on how much I can get from a life cover point of view?
It very much depends on the client's individual circumstances. So if there is a big bank loan or outstanding debt, that can be covered. And then one would look at the present income and extrapolate that over the next remaining lifespan of the client. And you would look at the liabilities, and then you would come to the sum assured in that way.
Okay, so a broad guideline perhaps would be that you're not allowing someone to potentially profit from a life insurance policy, but rather just mitigate any risk or negative impacts from a financial position. Okay. Neelan, just quickly from a risk pool point of view. Now, from what I understand in the industry, we get different risk pools and people get put into different risk categories according to a number of different sort of specifications. Perhaps you could expand on risk pools for us.
I think the key differentiator between the various organizations are pretty much income and education level, and they would be the determining factor. And primarily because the greater your income and education level, the more accessibility you have to resources. And what I mean by resources is the ability to take care of yourself better. And life insurance is basically about risk. So the concept is, if you're able to take better care of yourself, usually and traditionally you live longer, and obviously that is a better risk. So from a risk perspective, that would be the differentiator between the various components, and the rating scale comes in primarily based on education levels as well as income.
Okay.